welcome to MF Basics. I'm Lisa and you're watching episode 8. After having spoken about all different kinds of mutual fund schemes, we are now ready to talk about mutual fund taxation. Ab tax to dena hi hai, and all kinds of investments, whatever profits or gains you have from them, the government requires that we do pay tax on it. Mutual funds are no different. But let's see how mutual fund taxation can be made efficient and can be beneficial to you. Let's begin by talking about dividends. Now, there was a time when mutual fund dividends were tax-free in the hands of investors, and people really preferred that route to get regular income from mutual fund schemes. That is no longer the case. Mutual fund dividends, after the latest budget, are now taxable at the rate of your income tax. Whatever rate you pay income tax at, mutual fund dividends are also taxable at the same rate. So there is no real advantage to invest in the dividend option, and really, the growth option might work better for you. Coming to the growth option, what happens in mutual funds is, for the purpose of taxation, mutual funds are divided into two broad baskets: equity and non-equity. In equity, everything that is an equity-oriented scheme, that means at least 65% is invested in equity shares, is considered an equity scheme. Everything else is non-equity. So your debt funds, your gold ETFs, your international fund of funds, international ETFs, they're all non-equity schemes and are taxed as such. First, let's talk about equity taxation. This is pretty much like your equity shares, which means that in equity mutual funds, you have to be mindful of short-term gains and long-term gains, and these are capital gains. So any gains from the growth option of your mutual fund scheme is classified as a capital gain. It is a short-term capital gain if you have invested and then sold within 1 year in less than 12 months. It is a long-term capital gain if you have invested and then sold after holding for at least 1 year. In the short term, equity mutual fund gains are taxed at 15%. Long-term gains from equity mutual funds are taxed at 10%. But the first 1 lakh rupees of your gains are tax-free, and after that, anything is taxed at 10%. Now, this is very simple. It gets slightly more complicated for non-equity schemes. So like debt funds, gold ETFs, as I mentioned earlier. Here, the short-term period is defined as 3 years, which means that if you invest and hold for less than 3 years or 36 months, the gains are classified as short-term capital gains. And if you hold for anything more than 3 years or 36 months, it's long-term capital gains. And remember, these are all investments made in the growth option, whether it's an equity scheme or a debt scheme. Now, in non-equity schemes that we were talking about, the short-term capital gains tax is at your income tax rate. So, any gains that you make from selling non-equity schemes before 36 months, those gains are added to your overall income and it is taxed at the income tax rate which you would otherwise apply. Long-term capital gains for non-equity schemes are where the benefits lie. There is a lot of efficiency in that because those are taxed at 20% along with indexation. Now, what is indexation? Indexation means adjusting your original buy price or your cost as per the annual inflation for the number of years that you've held that investment. So if you've held for 3 years, you will adjust your original cost for 3 years of inflation and then apply that cost when you're calculating the gains. Let me just give you a quick example so that you see the actual benefit. Let's say you invested 100 rupees in a debt mutual fund in October 2017 and come October 2020, आपके 3 साल पूरे हो गए हैं. So 3 साल पूरे हो गए, अभी हम दिसंबर में, so that means you will be required to pay long-term capital gains tax on this. Now, in October 2017, आपने 100 rupees invest किया इसमें. The inflation index basis which the indexed cost is calculated is published by the government. You can ask your CA or your investment advisor. This is all available very simply, easily. You can even search for it online. Now, the inflation index table which the government publishes, for the year 2017, the table value is 272. For the year 2020, the table value is 301. So anything that is bought in 2017 will grow from 272 to 301 basis the inflation index. So that's how you will adjust your 100 rupees also. and basically the adjusted cost of that 100 rupees now becomes 110. Now let's assume that your debt fund gave you an annualized return of 7% for these 3 years. That means the value of your 100 rupees has grown to 122 rupees thanks to this investment. Now the value has grown to 122 rupees. Your adjusted cost is 110 rupees. That means your gain is just 12 rupees. Your non-adjusted gain would have been 22 rupees, and that would have been what you're paying tax on. But no, thanks to the rule of indexation, you are paying tax on 12 rupees. At 20%, that tax works out to 2.5 rupees. If it had been on the original value, it would have been much higher, slightly more than 4 rupees. So that's how indexation helps, and that's how it helps when you are planning and holding your non-equity schemes, your debt funds, gold ETFs for more than 3 years. So we've spoken about equity and debt taxation. I would also like to mention there is a special category of funds called equity linked savings schemes or ELSS schemes, which qualify for a tax deduction. These are called tax saving schemes as well. In ELSS schemes, you get a tax benefit under section 80C, जिसमें आपका insurance and your housing loan interest also falls. The upper limit to claim this benefit is 1,50,000. उतना आप इन्वेस्ट करेंगे तो वो सारा आपके इनकम से डिडक्ट हो जाएगा एंड आपको उस पर टैक्स नहीं पे करना है. So that's a big advantage. You can use this under section 80C. The limit is 1,50,000. You can of course invest more than that in ELSS schemes, but that is the amount you will get the tax benefit for. So that's one special category of mutual fund schemes where you can take advantage of the tax status. Then let's talk about systematic investment plans or SIPs. Each SIP is considered a new investment, whether it is an ELSS, whether it is in equity schemes, whether it is in non-equity schemes. Each SIP is a new investment, and that's where you have to be careful about your tax time frame, the short term 1 year or 3 years, and the long term. So every SIP you make in a month, the next month a new tax cycle will start for that month's installment. So if you invest in December, the 1 year is completed in November next year. If you invest in January, the 1 year is completed in December next year. So the tax treatment differs for each installment of SIP. You should be careful of that when you are withdrawing or redeeming your units, because you have to be mindful which is under long term or short term depending on when you made that investment, if it was through SIPs. So there you have it, mutual fund taxation. It is most efficient not only from a return perspective but also from a taxation perspective to hold your mutual fund schemes for as long as you can. Especially debt mutual funds are most efficient on the taxation front if held for more than 3 years. That's it for now, and do keep watching MF Basics for all things mutual funds.